Edward Brown, host of The Best of Investing, here to remind you to tune in this week on Saturday at 8 p.m. Our guest is going to be Kyle Kodareski. You're not going to want to miss this show. That's The Best of Investing on Saturday at 8 p.m. Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during the show. That certificate's not sponsored by the radio station, but by Tan Bella Tanning Salon with 2 locations in San Francisco and 1 in Marin. Today's trivia theme is baseball. We just love baseball. All right. Today we do have a special guest, Jack MacDowell of Palisades Group. And the name of this episode is Private Residential Care 101. Jack MacDowell is the co-founder, managing member, and chief investment officer of Palisades. He is responsible for leading all investment activities, including research, allocation, and risk management functions. Prior to founding Palisades from July 2009 until August 2012, Jack served as the chief investment officer of Carrington Capital Management. And let's see here, additional previous tenures with Credit Suisse, First Boston, RBC Capital, and Old Hill Partners. Well, welcome, Jack, to Best of Investing.
Awesome, Edward. Thanks for having me.
Oh, you're welcome. So give us a little background. What is Palisades Group?
Yeah, so Palisades Group, we started about a dozen years ago in 2012, and we're exclusively focused on private residential credit, which, I think a lot of people categorize private residential credit as like the 30-year fixed rate mortgage loan, when in fact, it's a $3.5 trillion market. It's a subset of the $14 trillion U.S. housing market. And we really have 2 verticals to our business. The first is where we are providing asset management services to large institutions who want access to private residential credit loans of all different varieties. And then the other side of our business is running a series of private fund vehicles where we have traditional allocators like, endowments, foundations, health systems, and so forth.
All right. And what is private residential credit?
Yeah. So when we talk to a lot of allocators, when we talk about private residential credit, we are talking about a subset of the broader U.S. residential housing market. But again, people think of it in terms of this 30-year fixed rate mortgage, when in fact there's a variety of different product types within that, $3.5 trillion sphere. And there's everything from, distressed residential loans to high credit quality residential loans. There's short duration, construction loans to builders and developers. There's home equity products. So really, when we think about portfolio construction and really just investing within our space, it's not so much about just going out and buying residential loans. We actually do think about portfolio construction where we're combining, product types, risk, return, duration, cash flow, credit profiles to create durable portfolios that can, ideally, persist through different housing economic environments.
So do you raise money? Like I manage the Pacific Southwest Note Fund, and we buy discounted mortgages. And most of them are performing, very little are non-performing. And we produce just a flat 8.5% yield to our clients. Do you guys have something like that?
And you say those are mostly performing loans?
Yeah.
Yeah, I mean, it's interesting. When we started the firm in 2012, and really from 2012 to, let's say 2016 or so, that's what our whole business was buying distressed residential loans coming out of the financial crisis. So we were buying packages of loans from, money center banks, the GSEs, Fannie and Freddie, and so forth. And then, our sort of core competency is working out distressed credits. Over the years, that opportunity set dissipated. And so we started to spread out into more traditional performing credit products. So you're exactly right, Edward. We're going out in our private funds. We're raising capital from traditional allocators. And then we're looking out over the horizon of what we consider to be the residential credit space, identify the products where we see the best relative value and allocate accordingly.
Okay, well, we'll definitely get into that in the next segment here. All right, here's our first trivia question on baseball. Let's see here. Okay, these questions may be kind of hard. Uh, who was the only Rookie of the Year award winner to be a Seattle Pilot? And if you don't remember, the Seattle Pilots were a very short term, I think it was 1 year, 1969. So who was the Rookie of the Year? And you should know at least this name if you're a baseball fan, because he ended up being a very good player as well as a manager. Call 888-912-1190. First caller with the correct answer wins that tanning certificate. I do want to make a mention here for the Transcendence Theater. Check out their upcoming performances. Bestnighthever.org. I went to a performance last week, and it literally was the best one they'd ever done. It's like Broadway. There was awesome, awesome music. All right. Stay with us. You're listening to The Best of Investing. Don't touch that dial. We are going to be right back. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with my special guest, Jack MacDowell of Palisades. First trivia question on baseball. Who was the only Rookie of the Year award winner to be a Seattle Pilot? So we're talking 1969. Are you a big baseball fan, Jack?
I'm actually not a huge baseball fan.
Okay. Well, this guy, you'd think of him as a player, and then a player. He played for the Yankees, and I think he managed the Yankees. He might have actually managed the Mariners too. I don't remember that, but Lou Piniella.
Oh,
Was the name.
I have heard that name.
Yeah, and surprisingly, he was the Rookie of the Year in 1969.
Oh, wow.
What happened was he in 1969 spring training, he got traded to the Royals. Actually, so he played for the Royals actually before the season began.
What was the name of that team you mentioned? That was one
Seattle Pilots.
Seattle.
Yeah, Seattle Pilots,
Wow.
and I think they became either the San Diego Padres or the Texas Rangers. I think they became the San Diego Padres, I think, but don't quote me on that one.
Wow.
I do want to make a mention here also for the Dr. Wilkinson's Backyard Resort and Mineral Springs, voted best natural hot springs in Calistoga by Travel and Leisure magazine. Call 707-942-4102 or go to drwilkinson.com. All right, so Jack, so tell us now, do you have a fund?
We do.
Is that how you
We
raise
have a
money?
series of funds that we manage and raise capital for, and we allocate to different residential credit product types. Yeah.
Okay. How large are your funds?
Historically, they have been, I think our last fund was a little over 100 million in total equity capital raised.
Okay, and then you take that money and then you buy various loans. And are they performing or non-performing?
It really just depends. I mean, we can invest across the spectrum of, opportunity sets. Like I said, historically, we were very heavy into the non-performing distress side and working out those credits. That opportunity set, from our perspective, has really dissipated in recent years. So in our recent funds, we've been exclusively focused, at least in recent years, on more traditional performing credit. So we've invested in home equity products, short duration, construction loans. Those have been really the areas where we've seen the most.
So you're not looking at the discounted loan market, the existing.
Not right now. We were looking at the scratch and dent market in 2022, when rates started to increase. I mean, that was a pretty interesting opportunity set.
Yeah.
Since there was over $10 trillion worth of residential loans originated during 2019 to early 2022 with super low interest rates, and then for whatever reason those loans were getting kicked out of Fannie, Freddie, mortgage-backed securities, and as rates were going up, the value of those loans were going down. So there were still good loans. They just had some underwriting defect, but you could, there was a period of time where you could buy those at a 25 point discount, which was really interesting. But
especially if for some reason the person sells the house, then you pick up that discount and make a great return. What kind of rate of return do you target for your investors?
So we're targeting a 14% net to our investors. We do use financing, so we leverage the assets, but like construction loans right now, we're buying those at around 10.5%. So they're, typically, I would say about 0.7 to 0.8 duration on a stabilized portfolio of construction loans. So it's, not taking much interest rate risk. there is this operational complexity component to them because you have draws over the life of the project. It's
Yeah.
not like you're just making a loan and you go about your business. So you're having to
especially if you do double Dutch interest, as they say. I
yeah.
don't know if you
We
can
were
do
actually getting some of that stuff when we first started investing in like 2019, early 20 in the product, but I think folks
Yeah.
kind of moved away from that. But it
What
was
they did.
nice.
How much leverage percentage wise is in your fund?
Typically, we get an advance rate of about 75% on our construction loans.
What about the non construction?
Yeah, so our home equity products, I mean, you can get, it's less leverage on that product. I mean, right now we've got probably 1-to-1 leverage, 50% advance rate on our home equity shared appreciation contract portfolio. There are rated securitizations that are being done in that space, where you can get, more attractive leverage metrics. But right now we're perfectly
Yeah.
happy with 1-to-1.
And what are your borrowing costs? What kind of rates are you paying
We're
to the bank?
typically paying a spread over SOFR, so that they're floating rate. The nice thing about the short duration construction loans, though, are that when rates were going up, a third of the portfolio was paying off every quarter, and so you're basically able to reinvest and recalibrate your buy rates as rates were going up. But yeah, we're paying typically SOFR plus a spread of a few hundred basis points.
Well, especially charging points up front. Yeah, because so I manage the Southwest fund that buys the discounted mortgages. We're unleveraged, and our average LTV, or they call it ITV because we're buying at a discount, is less than 40%.
Oh wow!
And so we just produce an 8.5%. Those I got to think that I've been in this business a long time. That's probably the most conservative loan out there, or fund.
Are these like
out
scratch
there.
and dent loans that you're buying from originators that are getting putbacks from Fannie and Freddie?
But mostly they were seller carryback notes originally, and then we started moving, and they were a little bit hard to find in the open marketplace for what we were raising money. So we started branching out a little bit and buying from. We were primarily in Texas, then we branched out to other states, and so we've been in. But we're doing some in New York.
Yeah.
A lot of people are scared of New York, but we're doing fairly well in New York. And then sometimes we modify the loans. Sometimes we had some non-performing loans, but for the most part they were just performing. Fairly conservative loans. They're not high-priced houses. A lot of these houses are 150,000 or less. So the way we looked at it was, everybody needs a place to live.
Yeah.
And, if you can afford a $500 a month mortgage payment and own your house, you're probably not going to default on it.
Yeah.
Compared to having to pay $1,200 a month for an apartment that you don't own.
Yeah, for sure.
So that's, and then we have some costs on that, but I can see where if you're leveraging, then you can get, that higher rate of return. You get taking more risk, but if you know what you're doing and you're managing it, then that should work out. All right, we got to cut to our next commercial break here, and we'll ask a trivia question next time. Welcome back to the Best of Investing. Edward Brown here, along with Jack MacDowell. So I do want to make a mention here before we get started again. Mountain Mike's Pizza in San Rafael, pizza the way it ought to be. Also want to make a mention for Axiom Hotels in San Francisco, located in the heart of Union Square. The Axiom Hotel blends a sense of history with modern touches. Guests rave about the staff and how quiet the hotel is, especially, when you're downtown San Francisco, Union Square. Check out axiomhotels.com. So off air, we were just talking about we do a lot of work with Pacific Private Money, and they have few hundred million kind of spread out into their different funds and individual investors. So they specialize in the owner-occupied consumer bridge loans. Not too many in California do that because of all the costs involved, the licensing and continuing education and software and legal. And if you're a typical fix and flip lender, why spend all that money if you're already doing well? So they decided to take the plunge, and so we do these short-term bridge loans for people who own a house but want to get into the next house.
Wow, that's fantastic.
Yeah, so it's a workout, and then they pay anywhere from 8% up to 11%, depending upon how much we put in.
That's
so
great.
that works
Sounds
out
like a
pretty
great
well.
product.
Yeah, no, it is. It definitely fits. There's some overlap kind of with what you do a little bit, but not too much though. So let's see here. And I assume that your funds, they're probably the with 506D. Did you have to be an accredited investor?
Yes, for sure.
Yeah,
Everything we're
the
doing
kind
is on
of
the institutional side.
okay. So are most of your investors institutions
They
versus
are, yeah,
individuals?
like foundations and college endowments, health systems, and so forth.
Well, they love that 14%
Yeah.
yield. How many loans generally are in a fund?
It just really depends. I mean, in Fund 3, we have a pretty healthy allocation to home equity contracts, which are just lower, generally lower balance products. So I think we've got 1,700 individual home equity assets in that fund. And then on the rehab and construction loan side, we've got securitization in Fund 2. We've got a financing facility, and I can't even remember how like the raw number of loans is right now.
Well, let me ask you about those HELOCs because I'm thinking if I'm a bank and someone's not using their HELOC, they're not earning interest on it, but yet they still have to kind of hold the reserves, don't they?
Yeah, I mean the interesting thing. So we're not actually not invested in HELOCs. So
Okay.
this is a home equity shared appreciation contract. It's
Oh,
really pretty
yeah,
cool.
got
Are you familiar with those?
it. I am.
Yeah, it's basically, somebody who has, equity in their home, they want to tap into it, but they don't want to increase the mortgage debt service payments. And so this is a way
Yeah,
where you're actually bringing in an investor alongside the homeowner and the equity, and they share in the appreciation of the home. And so
yeah.
there's no monthly payment associated with it. It's really just when the house is sold or they refinance or something like that, that we actually get paid.
It's almost like a reverse mortgage, but for those people who are
Under
under,
62.
62. Yeah.
Yeah.
And then generally, I know that some home equity participant type companies like yours, you can't be more than 30 days down or else they just won't even do the loan. Are you guys that way too, or do you
Yeah,
have
I mean, you're
flexibility?
not going to you're not going to issue a home equity product to a homeowner who's delinquent on their first lien mortgage. You know what I mean? Um,
Yeah. Oh, yeah. That's why I asked.
yeah,
Is
yeah. I mean, basically, you wouldn't think there's a mechanism to default on a home equity contract that has no scheduled principal or interest payment, but you actually do technically default if you're in default on the first lien, or if there's a failure to pay property taxes or insurance or
like
something
you say,
like that.
insurance. Yeah. Gotcha. Okay. Let's see here. Let's go ahead and cut to our next break because the last one I went on a little bit too long. I didn't get a chance to even ask our question. All right. Here's our second trivia question here. Talking baseball. And again, hard questions here, so don't be embarrassed if you don't get them. Name two pitchers in the modern era, so forget Cy Young, to win 20 games in a season for three different teams.
Oof.
All right, call 888-912-1190. The first caller with correct answer wins that tanning certificate, which, by the way, is worth $100. Name two pitchers in the modern era to win 20 games in a season for three different teams. All right, stay with us. You're listening to the best of investing. Don't touch that dial. We are going to be right back. Welcome back to the best of investing. One more time, I'm Edward Brown, your host, along with Jack MacDowell. Second trivia question: name two pitchers in the modern era to win 20 games in a season for three different teams. Any clue
No
or
clue.
any? Okay. One of them was in the 1960s, the other in the 1980s. So in the 60s, it was Gaylord Perry for the Giants, Indians, and Padres, and then Roger Clemens for the Red Sox, Blue Jays, and
Uh,
Yankees. These are kind of hard. I get it. All right. So Jack McDowell from Palisades. So let's see here. Who should be investing in private residential credit, and how can they get involved?
well, it's interesting because it sounds like that you have some funds that probably cater to a different investor base than our
Yeah.
funds do. So, what we're actually targeting institutional investors, and I think that private
Yeah.
residential credit has a very important place in an institutional portfolio, if for no other reason that, given where private equity is and some of the recent vintages of private equity, I think are struggling right now. Just if you look
Yeah.
at private credit in our sort of fund format, we're not targeting the 20% type returns that private equity is, but the dispersion of outcomes in our strategy are really pretty narrow. And so, not to mention just the fact that you've got a non-correlated asset relative to certainly to public market. So I think it's, and the other piece, and this is really the cornerstone of everything that we do, is you really have full transparency into the borrower, their situational profile, the property, the loan structure, and that level of transparency combined with the credit asset level credit decisioning processes that you can apply, you really can dictate or help influence outcomes in the portfolio strategy. So I think it's a great product. Obviously, I'm biased, but from my perspective, it really does need to be part
Well,
of
let me
the
ask you,
portfolio.
if you're generating 14% for the investors, how much extra on top of that? Because you guys have to make money too.
Yeah, it's typically like call it a 17% gross and a 14% net is what we're targeting.
Wow.
Yeah,
Okay. And what's the minimum investment?
5 million.
Okay. Oh, okay. So you really are looking at the institution, though.
Yeah, for sure, for sure.
Okay. Well, how do you market to those companies?
Historically, and that's probably an area that I would say over the years we've needed to gain the most improvement on. Like when we first started, the firm is very focused on building a very institutional quality investment team, building the infrastructure necessary to manage the strategy. And admittedly, I didn't focus as much as I should have on marketing and getting our name out there. So, it was just recently, I guess probably about a year and a half ago, we hired our first, seasoned, experienced internal marketing person, and she's fantastic. She's been in the business for a while. She's got great relationships, knows a lot of the, local allocators here in Austin. And we also recently brought on somebody who's a specialist on the consult with consultants. So, that's an area of real focus for us. But yeah, we do it internally, and we have worked with placement agents as well in the past.
Sure. Wow. No, that's a pretty powerful $5 million minimum on that. Let's see here. Okay, so what? Actually, let's talk about upcoming federal interest rate decisions coming up in September. What do you think?
Yeah, I mean, I guess there's a lot of conflicting data out there, and obviously the market, or if you're looking at the futures market, there's a better than 100% probability that we get a 25% rate or 25 basis point rate cut. So I think we're in that camp that we'll probably see, call it 2 rate cuts this year. But you still, if you're kind of looking at the data, the labor market is cooling, but the unemployment rate is still relatively low. I think growth has performed sort of outperformed what logic would tell you, and there does seem to be quite a bifurcation between the wealthy consumers and the lower income folks who on the upper end, people have seen their wealth continue to increase. They've got low interest rate mortgage debt, so where their home prices continue to go up. And then you've got the other end where folks have student loan debt, they're subject to rent escalations, and they're certainly much more susceptible to goods and services increasing in price.
Yeah.
So it's a tough situation. I do think too, when rates start to come down, the Fed has backed themselves into a corner, if you will, because housing is the largest component of inflation. And as rates come down, we're in an undersupplied housing market. As rates come down, you're going to release demand, pent up demand, into an already undersupplied housing market, which is going to continue to press on inflation. So,
and I always say, what do they say? A rising tide lifts all boats, and there's 10, 15 million people who just came into the country who maybe will start off at the lower end. They're all not going to live at the the Roosevelt Hotel in New York, so they're going to live somewhere, and that'll just start slowly pushing the prices up. So I totally get you on that.
Just need more affordable housing.
Yeah. But you know what? There's so many, as they call them, NIMBYs.
Yeah.
Right?
I mean, you've got
And that
that
happens.
issue,
I
and
mean,
that's a zoning issue in many cases. So it's really
yeah,
incumbent upon a lot of these state and local governments to redo zoning laws and increase the efficiency of the
and
permitting.
permit fees.
Yeah,
That's the big thing. They raise the permits prices so high, and the cost of goods like lumber, labor, and all that. The builders, I just can't make a
yeah.
profit, so it's not worth it to me. Okay, we're going to go to our next commercial break here. Let's see. Let's ask this trivia question. Okay, here we go. Who is the only major leaguer to hit a grand slam right-handed and left-handed in the same game? And oh, by the way, he hit it in consecutive innings. Just coincidentally. Kind of an obscure player, so I don't expect you to get this one. I think he also played for the Giants, if I'm not mistaken. But in 2003, he did this for the Red Sox. Call 888-912-1190. The first caller with the correct answer wins that tanning certificate. Stay with us. The Best of Investing will be right back with some closing thoughts and some thoughts for the day. You're not going to want to miss that. Stay with us. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with Jack MacDowell. And here's our third trivia question. Who is the only major leaguer to hit a grand slam right-handed and left-handed in the same game? And oh, by the way, he did it in consecutive innings. What do you think?
No clue, but I'm very
It's,
curious to see who it is. If I've ever heard of him.
yeah, Bill Miller.
Can't say that I have.
Bill, it's pronounced Miller, but it's spelled Mueller. Yeah, so yeah, I think he played for I think he was a third baseman, I think for both the Red Sox and the Giants, if I'm not mistaken, but that was going back in time. All right, so before we cut out here, what tips do you have for investors looking to expand into private residential credit, and also for those wealthy investors who do want to get a hold of you to invest with you? How do they do that?
Yeah, I mean, the tips, I would say, I think one of the most important things in our strategy is just making sure that you've got the capabilities, or whoever you're working with has the capabilities to work out distressed credits. Because at the end of the day, when, things are going great and the loans are performing, you know,
Yeah,
everybody's happy. But then when hardships arise, being able to understand situational profiles, understand how to work through distress situations with borrowers, whether it be homeowners, developers, builders, what have you, I think is probably the most important element of our business. And that obviously, when you're dealing with tens of thousands of individual loans and properties, it takes fairly robust infrastructure. So that's probably the most important
yeah.
thing, I would say.
Well, you have to have a good team for sure. How do people get a hold of you if they happen to have $5 million
Yeah, I mean,
just laying around?
we've got our website is Palisades. .us.com. So I mean, that's one way. And then our whole team's on LinkedIn and stuff like that. So we're always around.
How many
I have about
employees do you have?
40 right now.
Yeah, I was gonna say you need about that many for that size. What's your outlook before we cut out for the day? What is your outlook for the private residential credit for the remainder of 2024 and 2025?
Yeah, I still see home prices continuing to rise for all the reasons that we talked about. I think there's just this persistent undersupply or supply demand imbalance. And you can see that sort of throughout all the different supply demand parity indicators: month supply of resale inventory, days on market, owner occupied vacancy rates. So that's a theme that we continue to be focused on. And beyond that, it's just really keeping an eye on whether or not some of the challenges that we're seeing in other credit markets, whether it be credit cards, auto loans, and some of those delinquency elements start to spill over into the housing market. Up to this point, we haven't seen it, probably in part because there's $30 trillion of home equity in the U.S. housing market. Most loans have been underwritten really well. And you've got Ginnie Mae has sort of become the de facto subprime mortgage market. So you really don't see those types of loans entering into the private residential credit market anymore.
Yeah, I mean, I locked in at 1.99% fixed for 15
That's
years.
awesome.
So it's going to take, wild horses will have to drag me out. So I'm not one of those guys who's going to refinance, and I'm probably not going to sell because, where am I going to go to get that kind of rate again? It costs a fortune. So that takes a lot of inventory off the market.
Does. I mean, my wife and I are talking
Definitely.
about, doing some adding on to our house right now. And I'm like, wow, I don't want to like
Exactly.
stress
That's why
my
Home Depot.
marriage out going through a home renovation, but I
Yeah.
also don't want to like give up
Yeah.
my 2.5% mortgage either.
Exactly. So that's why I think companies like Home
Yeah.
Depot are going to do pretty well because people are going to just remodel their houses instead. Well, Jack MacDowell, it's a pleasure to have you. And here's our thoughts for the day. So, how many tickles does it take to make an octopus laugh?
No clue.
10. Tentacles. Tentacles.
Oh, I gotcha.
Ah, there we go. I
A
knew
little
I'd catch
slow
on
on
that
that
one.
one. Gotcha. That's
Okay.
good stuff.
Yeah. Now this one's a little kind of tongue in cheek here, but apparently the Secret Service is hiring individuals with roofing experience. Gulp. Slope roofs will get you every time. All right, tune in next week to the Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.